All right, I think it's fair to get started. Welcome everyone. Thank you for joining our webinar on P2P lending and taxation. We have a large number of people registering for the event. Clearly, there's a lot of interest from people to know a lot more about the taxation aspect of P2P lending. I'm Krunal. I handle marketing side of things at fundkiss. And from fundkiss, we also have Amar, who is here with us. Most of you should be familiar with him. He handles all the investor relations here at fundkiss. Just for the housekeeping side of things, Bobby has agreed to take questions while he's presenting as well. So we've got a Q&A tab at the bottom of your Zoom screen where you are okay to submit your questions. Bobby will try his best to answer them during the presentation, and I will provide the questions to him. Meanwhile, we also have a Q&A session towards the end where we could have more questions answered. All right, without any further delay, let me introduce you to our speaker. Obviously, P2P lending, quite an innovative new concept in itself, and we needed to clarify this for all of the lenders. Bobby has agreed to educate us on the topic. Bobby is currently a tax partner at Bakertilly Mauritius with over 20 years of experience in tax, local as well as international. Previously, he has worked at the MRA, as well as two of the big four firms before he joined Bakertilly. He's a regular speaker at international events, and really we couldn't think of a better person to do this with. So Bobby, thank you so much for doing this for our lender community. I think they will really appreciate it. We are free to begin, and Bobby, I'll stop sharing my screen so you can begin your presentation.
Thank you, Ronald. So good afternoon, everyone. Ronald, if you can enable my sharing of screen, please.
There we go, Bobby. That should work.
So can you all see the screen in presentation format, or?
We see the PowerPoint format. We just might have to switch the screen to a bigger screen for the presentation.
Is that fine now?
Perfect, Bobby. That works.
Okay, so good afternoon, everyone, and thank you for joining us. Thank you, Prunal, thank you, Amar, and thank you, Paul, for giving me the opportunity on behalf of Bakertilly to share with you, the taxation aspects with regards to peer-to-peer lending. So let me go through maybe the table of contents. So today we'll cover an overview of the taxation part of peer-to-peer lending, the peer-to-peer tax incentives, small enterprises, individual taxation, and then part of the budgetary measures relating to the peer-to-peer lending and individual taxpayers. So the P2P lending starts from the lending platform itself, and fundkiss being the platform. And through that platform, you've got lenders who are mainly individuals and institutions. Then you've got private individuals and business who are the borrowers. So what happens is that the lenders would make investment through the P2P platform, fundkiss, and then the funding goes to the borrowers. So this is the flow. Now what happens next is that the borrowers would repay the capital element plus the interest to the platform, and then the interest plus the principal goes to the lenders. Now, what are the tax incentives? So the first one being the partial exemption. So first of all, it's important to highlight that partial exemption came into effect in 2019, which replaces what we call the deemed foreign tax credit within the global business sector. So in principle, only part of income now are subject to 80% partial exemption, which means that only 20% of the interest is subject to income tax. Obviously, the 80% are exempt from taxation. So this is a general principle which relates to partial exemption. Now, the interest income with regards to P2P will also qualify for the 80% partial exemptions, which means that the interest which is received by a person would be subject to tax only to 20%, the 80% being exempt from taxation. Now, there is no requirement to satisfy any substance requirement to qualify for this exemption. What does that mean? For a company in Mauritius, they've got, when they claim partial exemption on interest, they've got to satisfy there are three categories of requirements. One is they've got to carry out the core income generating activities in Mauritius, the CIGA. The second one is that they've got to employ directly or indirectly an adequate number of suitably qualified persons to conduct their core income generating activities. And the third one is that they should incur a minimum expenditure proportionate to their level of activity. So this is applicable to, companies in Mauritius, whether global business or even domestic company, in order to be able to claim the partial exemption on interest. This is not applicable when it comes to interest relating to peer-to-peer lending. Now, the second point is bad debts. So in general, so in principle, bad debts would be allowed when they have proved to have become bad, and they can be deducted from the gross income. So for any kind of individual or even companies. Now, unrelieved bad debts cannot be carried forward for offset against future income. So this is the general rule about bad debts for individuals and companies in general. Now, for P2P, the amount lent or the interest which becomes and is proved to have become bad may be set off against the interest income from the P2P lending with the excess balance that could be carried forward indefinitely and set off against future P2P interest income. So this is quite different from the general rule which relates to bad debts. Now, TDS. So the general rule again for TDS is that it is retained. Let me move that here. So TDS is retained on interest payable by any person to any person other than a company resident in Mauritius. So this is a general rule in the Income Tax Act. Now, when we go to P2P, there is no TDS on interest from borrower, but that is a gross interest which is received from P2P. So this rule, which is generally applied to other parties, is not applicable when it relates to P2P lending. Now, let me show you a practical example which relates to the application of the partial exemption. So I've taken two types of income. One is interest income, and the second one is foreign source dividend. So you can see it's 120 and 200K USD. Now, there are common expenses, and the total makes 50K. Now, for the purpose of tax computation, what we usually do is to apportion expenses. So why the expenses is apportioned? Because when a company or someone benefits from the 80% partial exemption, that means that 80% is exempt. So expenses attributable to the exempt income should be disallowed. This is the reason why the total expenses is multiplied by 256. So what is 256? You will see it's the 80% which is exempt, 96 for the interest, and 160 for the foreign source dividend, which makes a total of 256. And then the total income is 320. So 256 over 320 multiplied by 50, 40 out of 50 is disallowed because 80% of the income has been subject to partial exemption. So 80% is 96 and 80%, you see, it's 160. So you've got a chargeable income of 54. So the income tax is at 15%. So this is how the partial exemption is usually applied when it comes, for example, for a global business company or even a domestic company. Now, let's have a look at the tax incentive when it comes for the operator, that is fundkiss. So the operator of the P2P platform is entitled to a tax holiday of 5 years, okay, on income derived by the operator. So there are conditions attached to that. So it should have started operation before December 2020. I think this is the case. And the income is from the operation of the platform. So even if the platform is receiving other kinds of income, it would not be subject to the tax holiday. Tax holiday applies only to the income derived under the license of P2P. Now, the operator satisfies the substance requirement. So I've mentioned the substance requirement. So these are also substance requirement, the core income generating activities, the employment, and the expenses, the minimum expenditure which should be incurred by the operator. Now, what happens in other jurisdictions? If we take the example of UK, so the interest income from P2P is taxed at 20%, 40, 45. So interest income from P2P, after applying the tax relief, is taxable at the same rate as other income. So they don't benefit from the incentives that we've got in Mauritius. So if we take the example of Portugal, so it's at 28%. So there are other advantages which are available there. For example, if a foreign resident moves to Portugal and earns interest only from P2P marketplaces abroad, so that person can profit from the 0% tax rate on these, providing the originating country, provided that the originating country does not tax the interest for 10 years. So this is a condition relating to Portugal. Now, for India, the interest income from P2P is taxed in the range of 0 to 30%. Now, let's have a look at the small enterprises. So you've got a simplified tax regime actually for small enterprises, SE. So a SE may elect to pay a presumptive tax at the rate of 1% of its gross income. So this election is irrevocable. That is, if the SE opts for the 1% instead of the 15%, so he can't go back. The definition of a small enterprise is that a person who is engaged in forestry, fishing, manufacturing, etc., and the annual gross income should not exceed 10 million, and the gross income from other sources should not exceed 400K. Now, I've taken a very simple example to illustrate what makes the difference between the presumptive tax and the standard tax of 15%. So I've taken an example where the turnover is 5 million, and in that case, the person is deriving rental income of 200K. The total is 5.2K. So there are common expenses of 1.5 million. So we've got a chargeable income of 3.7 million. So being taxed at 1%, so the amount of tax would be 52K. And in the same circumstance, if the tax was at 15%, the person would have paid 555K. So you can see the big difference which exists between the presumptive tax and the standard tax. Now, VAT. So you've got now what we call the VAT annual accounting system for small enterprises. So a small enterprise is eligible to operate the VAT under such system, that is the AAS. The AS can be operated either under the accrual basis or the cash basis. Now, the VAT filing required in respect of the first 3 calendar quarters in the small enterprise accounting year, with a final annual tax return at the end of the accounting year. So it has eased the VAT returns for small enterprises. So a quarterly tax liability is to be determined at 25% of the preceding accounting year's VAT payable. So there is no need, to calculate the actual VAT. It can base itself on the previous year's VAT payable after adding back any allowable input VAT in respect of capital goods. Capital goods, you can claim it separately. So this is a rule when it comes to the new VAT system for small enterprises. Now, there is a possibility for a claim for repayment. So possibility to claim that refund of excess input VAT, where same includes VAT paid in excess of 50K with regards to capital goods. Now, individual taxation. So the tax rate is 10% when a person derives less than 650K. And if it's above, the tax rate is at 15%. So it's not an ascending band where a person would be subject to tax on the first 650 at 10 and the next income, which is 100 to 200 at 15. It's like if a person is deriving 650, it's going to be 10%. And as soon as it exceeds that amount, so it goes up to 15%. Now, solidarity levy, which is has been in actuality for a number of I would say months and even more than a year now. So it's applicable on the leviable income exceeding 3 million rupees at the rate of 10%, right? 20%, excuse me. Then it is subject to a cap of 10%. I'll show you an example in a couple of minutes. Now, the leviable income includes exempt dividend from resident companies. And then the leviable exclude prescribed lump sum. So if a person is getting a lump sum in a particular year, this should be excluded in the calculation of solidarity levy, because sometimes it might be huge amount at the end of the career of a person. And I guess this should be the reason why they've excluded lump sum for the calculation of solidarity levy. Now, it does not apply to non-residents. So I've taken an example for the calculation of the individual income tax. So you can see that for a tax resident, the annual net income is 550K, and then the income exemption threshold of 325. Then the chargeable income, so the tax is at 10%, which makes 22,500. Now, for a non-resident, that person is not entitled to the income exemption threshold, and the 10% is applicable to the emoluments. That's why the 15% give rise to a tax of 82,500. Individuals who are not resident for tax purposes are not entitled to the income exemption threshold. So you can see that for the non-resident, that person is not entitled to the income exemption threshold. Now, a practical example for solidarity levy. So I've taken two scenarios where in the first one, a person is deriving total income, including emoluments of 3.5 million. And then the second one, 6 million. So I've taken the income exemption threshold to be like category A, 325. So you've got the chargeable income and the tax. This is the tax that should be paid on the income derived. Now, for the solidarity levy part, so you've got the chargeable income. And then for sake of this calculation, we've taken local dividend, which is normally exempt from tax. So the local dividend appears here. So the total leviable income now is 4.1 million. Then we apply the exemption of 3 million. So we are left with a total leviable income of 1.1 million. Now, how the solidarity levy is calculated? So it's 25% of the leviable income. That is 25% of 1.1. So you will have 293. and then 10% of the net income, so 10% of 3.5 million, that is the emoluments and business income. And then the solidarity levy is the lower of the 25% of the leviable income or the 10% of net income. And in scenario 1, you can see that it's the 293, which is the lower. Now, if we take scenario 2, the same principle will flow. 25% of the leviable income and 10% of the net income of 6 million. So you can see that the solidarity levy is at 10%, which is lower than the 25%. So all in all, the solidarity levy should not exceed 25% of the tax when it relates to the total income of a person in any particular scenario. So this is a maximum which is paid at 25%. Now, contribution sociale généralisée, the CSG. So the rate applicables are monthly salary, 1.5% up to 50, and the employer should pay 3%. And if it exceeds 50,000 rupees, so it's 3% for the employee and 6% for the employer. Now, for NSF, there has been a change in the ceiling as from July 2021. So we received a correspondence, I think, a couple of days back. So it's no longer 19,000 and something, 19,900. Now it's 21,255, right? Now, if we have a look at the a comparison between the NPF, which was previously applicable, and then the CSG, so you can see that there have been major changes in terms of contribution, both for the employee and the employer. So if we take the example of an employee earning 50, so the NPF was 597, so for CSG it's 750. So a 26% increase, and for the employer, you can see the same increase, and the amount is quite huge in terms of for NPF, the employer was 1,100, now it's 1.5. So if we take case 2, the same principle would apply. So for 100K, the employee was contributing 597, and now for CSG, he's got to contribute 3,000. So maybe 4 times what the person was contributing previously. And the same principle apply for the employer. So in the case 3, it's the same thing. So you can see to what extent there has been an increase in terms of contribution, both for the employee and for the employer. Now, penalties. So basically, the general one is that it's 2,000 for late submission of tax return for corporate and 2,000 for individual. For SE, it's limited to 5,000 rupees. So you've got penalty on late payment of tax as well, 5% and 2% for SE. And for individual, it's 5%. And interest on late payment of tax, 0.5% per month and 6% at start. Now, I had a request from Krunal regarding how this would be declared in the tax return. So the income tax return provide for a particular section, it's section 4. And we've got notes, you can see note 6 here. So basically what would happen is that the person should declare the interest derived from income money lent and then apply the 80%, which I mentioned earlier during the presentation. So 80% would be exempted. So if a person is receiving 100, 80% would be 80. So it's only the 20 which is subject to tax. Now, in the event the person has bad debts from money lent, this is where the person would deduct the bad debts. So if the person had a charge, let's say for this instance, interest income of 20, and the bad debts is 20, so basically there is no chargeable income which relates to interest. Now, if the income, the net income from interest is, let's say, 50, and then you've got, let's say, bad debts, which is 100. So basically what happens is that the 50 would be deducted. So basically there is no tax on the interest received. And then the next 50 out of the 100 can be brought forward, carried forward to the next year. And these bad debts can be carried forward indefinitely until it's like completed. That is, it has been used fully against interest income derived in each and every year. Okay, so I was referring earlier. Yes,
just sorry to intervene. So what we're seeing on the screen is an actual extract from the MRA document, the income tax return document, and they allow for these fields to be filled this way. Is that correct?
Yes, correct.
Perfect. So this is exactly how they will be filling their returns, our investors, when they put their P2P lending interest income in there.
Exactly. So basically, if a person is filling his or her tax return on the website of the MRA, so by filling 4.21, so the amount of interest would appear there, and then I guess automatically the 80% would be applicable. The systems will cater for that.
Mm-hmm. We also have a question, Bobby, we have from someone in the audience. They're a lender at fundkiss for the financial year 2021, so FY21. His total income is lower than the limit for exemption because they moved abroad. Do they still pay tax on interest obtained from fundkiss?
No, I did not understand the question properly. So is it that when the person is saying that the interest income is lower than the threshold, are we talking about the income exemption threshold?
The question was raised by Rajiv. I'll actually let Rajiv, if you don't mind, Rajiv, would you be able to explain the questions to us? Rajiv? I think you're on mute, Rajiv. No worries. Let me try and repeat the question for you, Bobby. So Rajiv was a lender at fundkiss financial year 21. And they say that their total income is lower than the limit for exemption because they moved abroad. Meaning I will not have to pay tax for the last financial year. So do I still pay tax on interest obtained from fundkiss?
Okay, let me maybe answer the question in a couple of ways, which will cover if I've not understood properly. Sure. Okay, let's take an example of a person, and I'm not taking the case where you have just mentioned. I'm taking a general case where a person is entitled to an income exemption threshold of 325K, right? Now, for sake of discussion, the person receives interest in FY21 only to the tune of, let's say, 100K for sake of discussion. And the person does not receive any other kind of income. So basically what would happen is that the income exemption threshold is much higher than the income from the interest P2P. So basically, yes, there is no tax. Now, if the person is benefiting from other income, let's say emoluments, and will still take the threshold of 325, let's say income from P2P is 100K and emoluments is 200K. So the total is 300K, but the income exemption threshold is 325K. So still the person is not subject to tax because the income exemption threshold is higher than the income derived by that person, both if it relates to business income, emoluments income, or even the interest from P2P. So let's put it like this. If a person is entitled to a particular exemption threshold and the total income derived by whatever the source it could be, to the extent that the income does not exceed the income exemption threshold, there should not be any tax liability on that person.
Yeah, I think that answers their question. They're quite happy with the answer, actually. Thank you, Bobby. I would also just remind the audience to use the Q&A button rather than the chat button to submit their questions, just so it's clearly visible to all the panelists here. and that would really help. But yes, Bobby, we can continue for now.
Okay, I was referring to note 6, in the tax return. So I'll just read the note 6. So it mentions where a person deriving interest from peer-to-peer lending, 80% of such amount is exempted from tax. So this is what we'll say. Now, any amount lent which have become bad may be deducted from the interest received through the peer-to-peer lending platform. So this is also what we have mentioned relating to bad debts. Now, any debt or interest which cannot be fully relieved may be carried forward and set off against interest received on the same peer-to-peer lending platform in the succeeding years. So it can be brought forward indefinitely. So there is one important element that I should point out here, is that it says that the any debt or interest which cannot be relieved fully may be carried forward and set off against interest received on the same peer-to-peer platform. So for sake of discussion, if a person is receiving interest from 2 different platforms, so that person cannot set off, bad debts from one particular platform to another platform. So it should be distinguished between each and every platform. So this is what is mentioned in note 6. I wanted to highlight that. It's very important. But I guess it's not applicable for the time being. This is my understanding. So shall we pursue, Kruno? Can we carry on?
Yes, please.
Yeah.
Yes, please.
So I would also like to mention some budgetary measures, not all of them. We've got quite a number in the budget which has been mentioned, but I would like to cover some of them. Like the first one relates to SMEs. So SMEs may receive a refund of salary compensation paid to employees up to a maximum of 375. So this 375 was paid in Jan, so the cost of living allowance, so it was adjusted. But SME can receive a refund of this amount for each employee per month. So this compensation applies for the period of January 2021 up to June 2022, so for 18 months. The second one is small enterprises who have opted to pay presumptive tax of 1% on their turnover will be exempt from the contribution to CSR. So basically a domestic company or even a person is subject to CSR at the rate of 2%. So small enterprises who have opted to pay the presumptive tax of 1% would not be entitled, to pay this 2% CSR. Now, the other measures, it's as many of you might be aware, you've got the Social Contribution and Social Benefits Bill 2021, which was introduced to Parliament on the 13th of July 2021. And I understand that it has been voted on Tuesday. So it should be subject to assent by the President of the Republic. So what are the changes that have been brought in this new legislation? So if you look at the table, it says others and self-employed, that is employees. People earning less than 50K, so that person is considered to be a participant and should be 1.5%. I mentioned it in my previous slide. And the employer will contribute 3%, right? So it's the same as the existing CSG regulations. Now, people earning 50K, the same principle will apply. So the participant will pay 3 and the employer would pay 6. So this is also the same. Now, this one is a change that has been brought. So for domestic service, less than 3K, the participant will not pay. It's the employer who would pay the 3%. Now, the other categories that has been introduced is those who are self-employed. So for self-employed, earning a net income up to 10K, the amount is 150 rupees. So there's no employer here. If the net income is between 10 to 50K, so it's a higher of 1.5% of 90% of the net income, or 150 rupees, right? So the fixed rate is 150 per month. Now, if the net income exceeds 50K, so it's 3% of 90% of the net income. So this is new and it's applicable to all self-employed. I mean, the participant has been defined in this bill. In this bill, it has been defined. So it covers all persons who are self-employed having BRN. So there is a long list. Okay. Now, both employee and self-employed. So this is a case where the person is considered to be an employee, but at the same time as an employer. It relates mainly to self-employed, where they are paying themselves a salary. So the same principle will apply. That is, if depending on the income, it's either 1.5 or 3. And for the employer rate, it's 3 or 6. I guess this was my last slide, Prunal. So may take any questions if people might have.
We've got one at the moment. Meanwhile, I encourage the audience to submit any other questions they might have about taxation to do with P2P or otherwise. A question here from the audience, Bobby, is what are the thresholds for SMEs and small enterprises?
I mean, the threshold is applicable to the individuals. It's not applicable to the entity as a small enterprise. So you've got different categories of income exemption threshold ranging from personal. It's as far as I recall, it's 325, and depending on the number of dependents, so it changes. So for individual with no dependent, I'm talking for 2021, it's 325. So someone with one dependent, 435, with two dependents, 515, three dependents, 600, 4 dependents, 680. Now, if a person is retired or disabled with no dependent, so it's 375, and a retired person who is disabled with dependents is 485. Now, this is the income exemption threshold, but apart from that, a person can take other deductions like, contribution to solar energy, interest on housing loan, child studying abroad, contribution to medical, medical contribution to medical insurance. So there are a number of other deductions that a person can take over and above the income exemption threshold, which is fixed.
And just to add to that question, I think we've received more clarification on that question, which is, what are the actual threshold, as in what is the turnover to qualify as SME or a small enterprise?
So I mentioned it
in distinction made.
Yes, I think I mentioned it in my previous slide. It's 10 million to be qualified as a small enterprise. So the annual gross income should not exceed 10 million. And for SE to benefit from the presumptive tax of 1%, it should be engaged in agriculture, forestry, fishing, manufacturing, retail of goods, including sale of food to be consumed off premises and wholesale of goods. So this applies to the presumptive tax of 1%. However, an SE, the gross income of an SE should not exceed 10 million.
Right, so 10 million and above, and then no longer an SE.
Yes.
Perfect, perfect, that answers it. We have another question, if you could help out here, Bobby. Can you please shed some light on the house loan for tax relief for individuals, please?
Which loan, Prunal? I did not hear that properly.
The question mentions on the house loan or housing loan, I believe.
Housing loan, yeah.
For tax relief for individuals.
Okay, so basically interest incurred for housing loan for the first house can be deducted into two. So the whole amount, so the person who should be receiving a certificate, let's say from a bank for the housing loan. Yes, so based on that certificate, all the interest can be claimed, and such interest can also be claimed in any proportion between spouses. So they can allocate whatever amount between themselves. So this is the only, I think this is the only deduction where spouses can share. So just to make sure to optimize For example, let's say one spouse is taking all the interest, but it's not giving rise to tax at the end of the day, when part of it could have been used by the other spouse.
Right. I hope that answered your question. That was an anonymous question. Next, we don't seem to have questions here. Yes, we have one. This is probably for us. Does fundkiss send a report to MRA on interest income by investor? I mean, does MRA know if we are receiving income? To answer your question, Sharad, no, we do not. Any interest or income earned, it is your responsibility to file your interest and income tax. Correct me if I'm wrong, Bobby, but that should be the case.
I mean, maybe the question was more likely whether fundkiss would issue like banks certificates of interest. If I guess yes, and if fundkiss is issuing such certificates, then it is the responsibility of the person receiving the interest. Yes. So the general principle relating to taxation is that a person should make a self-assessment of the income derived. So it's the responsibility of a person to declare all their income, whatever be the source, to the MRA. Now, the other angle that we could maybe look at this question is that the MRA has got very wide powers. For example, it's possible and it's highly likely that the MRA might be writing to the platform and requesting a list of all persons benefiting from interest, including, the amount. This is provided in the law, where they can request for information. So the Director General of the MRA has powers to request information, and it's a duty, on the other party, and it does not only relate to fundkiss. So they can write, for example, tomorrow they can write to, let's say, you've got someone dealing in retail for oil products. So they can write to the company, delivering the oil products to that company who is selling on a retail basis. So they can write to them and ask how many, gallons or liters of oil this retail has bought from you. So the MRA, they usually do it. We call it circularization. So they will circularize, and they will be aware who and what amount in terms of quantity they bought, and taking into account their stock, the MRA will conclude that the difference has been sold.
Right. We are legally obligated to submit financial information to MRA. Anyone who's conducting business in Mauritius.
Not by yourself, not yes. Voluntarily, but if upon request, yes, the law provides that you are required to provide.
But to finally answer the question from the audience member, we don't actually provide this data to MRA, at least not on a personal basis for our lenders. We do issue to our lenders a tax report as well as an investment summary. This has to do with your investments with fundkiss. And you would in turn use this information from those documents to file your income tax returns. This is done so on a quarterly and an end of financial year basis. And I hope that answers your question. Right, we have perhaps one more message here. Bobby, that's a question for you. With regards to net income of self-employed people, are we referring to their turnover per month for the purpose of CSG?
The net income. So
self-employed people, yes.
Yes, net income, it's gross income less all allowable expenses for tax purposes. Correct.
So for the purpose of CSG, are we referring to their monthly turnover?
Yes.
Right.
Yes. So there is an option for the for self-employed to make a return on a yearly basis. That is, for example, if it's 150, then it's 150 multiplied by 12, and at one go the return is made. But if it's on a monthly basis, obviously the calculation should be made in what range they would fall, whether it's less than 10K, it's between 10 to 50, or it's more than 50. obviously, and then remit that to the MRA. So there is a platform that would be introduced by the MRA for such contribution, and the effective date of operation for the new CSG would be the 1st of September.
Right, that explains. A couple more questions we have. One of them is, and you might have to reiterate the tax incentives on P2P lending, because the question is, the interest that we obtain from investments in P2P, is it taxable at 20%? If you could just run through that breakdown one more time, Bobby.
Yes, so because interest received from P2P is subject to 80% partial exemption. Obviously, the 20% is subject to tax at the rate of 15%.
Mm-hmm. So let's say if I receive 100,000 per year on a P2P interest income,
yes,
80,000 of my 100,000 are basically exempt from taxation. The 20,000, 20% or 20,000 would be taxed.
Correct.
Right. Thank you for answering that. A couple more questions. It's great, guys. We can probably accommodate a few more questions. If you have them, please send them through. Next question for you, Bobby. Is CSG tax deductible? If not, are we not double taxing the CSG portion of our salaries?
No, CSG is not deductible. And yes, you know, from a tax perspective, you've got quite a number of items which are not deductible for tax purposes. So basically, as far as I recall, it's rated as it's defined as a tax, and a tax is not allowable, as opposed to NSF. So basically, as far as I recall, this is not deductible, and on this basis, yes, it's not double tax. I won't say double tax. So you're not benefiting, you know, from the deduction, which will reduce your taxable income. But I would prefer for the social contribution and social benefits to be effective. So then the income tax also will be amended. So if it falls within the definition of tax, then it's not allowable, because a tax is not allowable for tax purposes.
Right. That answers that. Another question here we have, it's our local bank interest. So interest from local banks, let's say, are they fully exempted to a tax resident?
Yes, income derived by an individual from banks is exempt from tax.
What does that include exactly? Is that high savings account, high return savings account, etc.?
Savings account, fixed deposits account. So if you refer to the note 6, so if you refer to note 6, it will mention, you know, and then the Income Tax Act provides for exempt income, and interest income from savings account from a bank, including fixed deposits, are not subject to tax. So they are exempt from tax.
To local tax residents, whoever is immigration tax residents.
Yeah.
Perfect. No, great. I don't see any other questions. Give you guys another few seconds if anyone has any questions to submit. If not, we will be wrapping this up really soon. All right, I guess that is the end of that. Let me just quickly thank Bobby once again for doing this for us. Bobby, we really appreciate it. And I'm sure the audience found the webinar very, very insightful. Any closing remarks from you?
No, I would like to thank everyone who attended this session. I would like to thank you and the fundkiss team regarding this association. And if anyone has got any particular question which does not even relate to P2P, feel free to reach out to me. Mm-hmm. So thank you very much for that.
No worries. To our audience, you can see the contact details for any of your tax-related queries or accounting and consulting in general. You may refer to Bobby at bakertilly.mu, or send them an email at info@bakertilly.mu, and also their phone number. feel free to visit their website, check them out. And for any queries to do with your lending and investing with fundkiss, feel free to directly questions to us in the future. Thank you so much, everybody, for attending today. Hope it was insightful. And thank you, Bobby, for doing this for us.
Thank you very much. Bye.
Thank you. Bye-bye.